Hello and welcome to today's Sherpa Funds Technology Process Alpha webinar. For those of you, we have signups this time from the US, Europe, and Asia. If you're actually online in Europe at this hour, more power to you. My name is Stephen Quimby. I'm joined by my colleague, our CEO and founder, Richard Waddington, for today's Managing a Good Portfolio Construction Process webinar. And so this is going to build on some of the things we've talked about previously, where we talked about the different stages of the portfolio construction process. This is going to talk about some of the tools, some of the techniques that really go into managing that process to make sure that you actually capture the value of improving your process and using quantitative techniques to build better portfolios. So broadly speaking, again, if this is your first Sherpa webinar, we will take questions at the end, so we will try to set aside as much time as we need for Q&A. If you have a question that you'd like to pop into the chat in the webinar panel during the middle of the session, please, by all means, if we can get to it midstream, we will, but otherwise make sure that we stick around to the end and we'll tackle all those questions. We'll be about 30 minutes, 25, 30 minutes plus or minus, so just in terms of expectations. So what we're going to talk about today in terms of managing a good portfolio construction process, we're going to talk about how you can think about grouping the portfolio construction inputs, the decisions that you make, in a way that you can measure to see what's working and what's not, to see what you're doing well, to see the things that you might lean into, to see the different parts of the portfolio construction process and how those impact what your actual results are. And so we're going to take these inputs, selection, scoring, shaping, and sizing, and then we're going to put those together into a scorecard using the candidate portfolio analysis that will tell us what is actually contributing to the success or to the struggles of the portfolio. And then we're going to see how you can use that scorecard as a simple rubric, tracking it through time to really help improve your decisions over time. So in any given period, it might be noisy, but if you track that scorecard over time, it's going to give you a lot of insight into really what the drivers are of your portfolio performance through time. And again, as I said, we'll take questions at the end. So broadly speaking, the reason why this is a really important topic is if you don't know what's working and if you don't know what's not working, you don't know what to improve. From an analytical perspective, from a sort of process engineering perspective, you have to be tracking in some detail what is actually working. You have to be measuring it so that you can improve it, so that you can focus on the things that maybe aren't working as well and try to improve. And so when we talk about our 5 stages of portfolio construction, so understand, define, calculate, explain, and manage, this is a key part of that 5th stage of managing the process. And so if you do this over time, if you measure what you're doing, if you measure the parts of the portfolio construction process well, this will give you a more informed set of decisions for understanding what you're good at and for defining what you want your portfolio to look like. And so this is something where it's really important for us to isolate these decisions so that we can make more informed decisions on the other parts of the process. So one of the things that we see all the time with BMs, and this is something that I talk about a lot, is that most fund managers live in a world of huge amounts of data devoted to the individual assets rather than sort of the groups of assets or the types of decisions they make. So those are questions about why do you have 4% in this stock? How did this stock do? Why did you lose this much money in this stock? And while that's certainly an important thing to track, I mean, the P&Ls at the end of the day contributed to how that stock did. From a decision-making capability, what we really are thinking about here is how did I do in my high conviction ideas? Or why did I have weight this type of stock, this type of idea? And so what we're going to talk about today is grouping those ideas into these four buckets that we've talked about so that you can think about your process and think about your decisions as a statistical process rather than single asset, single point. So you can think about, am I doing good at a statistical level rather than did I do good at picking GameStop? So this is an important part really of managing a structured process-driven approach to building your portfolio. So broadly speaking, like I said, we're going to talk about this in terms of 4 sort of critical inputs or critical outputs, even if you will, of your own process. So the first one is your asset selection. Which assets, if we're talking about equities, which stocks do you want in the portfolio? The second one is asset scoring. What's your forward-looking view on those assets? Which asset do you like more than maybe the other assets? The third is going to be our portfolio shape. So that's, what do you want your portfolio to look like? What's the box that you can play with those assets? Fourth, we're going to talk about construction and sizing. So given those assets, given those scores, and then given the shape of the portfolio you want to build, how successful were you at combining those assets, sizing those assets to achieve the objective you wanted? There's another topic here that we're going to skip over today, sort of a fifth S, if you will, and that's in structuring. So if you were to be sort of a non-equity spot, this might be more important. If you're in equity and you're doing things with options and trying to structure different payoffs, this again might be more important. But today, what we're going to focus on is selection, scoring, shaping, and sizing as four characteristics that basically every PM really has to keep their eyes on. So the tool that we're going to use today, and again, we've talked about this in a couple of prior webinars, because at Sherpa, this is one of the sort of key drivers we use to understand portfolios, to understand the world, is the candidate portfolio analysis. And so the candidate portfolio analysis can give us insight into all of these different characteristics, into selection, scoring, shaping, and sizing. And using different metrics or different sort of shapes, different sort of statistics out of that candidate portfolio analysis can help us really understand the driver of, is my selection contributing more to my results versus my sizing? Or is the shape consistent with what I want it to look like? Or is the shape maybe giving me a wider box than I necessarily realize? So the candidate portfolio analysis is sort of the bedrock that we're going to build these metrics from, build our scorecard from. So for those of you who haven't checked out our previous webinars, we do have webinars, blog posts, white papers about the candidate portfolio analysis. So by all means, please check those on our website. Broadly speaking, for those of you who are new, the candidate portfolio analysis is a tool where we generate many eligible candidate portfolios that are compliant with the set of objectives and constraints, the set of portfolio shape definitions, and use the same set of asset selections and scores. And so that's to say, these are all of the portfolios, or a sampling of all of the portfolios that the PM could have constructed based on that set of inputs, that set of decisions at that point in time. Now, in the past, we've talked about this as an ex-ante tool to think about looking backwards and to think about it in the terms of understanding what your constraints are doing for how your portfolio shape works. We've talked about this in terms of assessing whether or not your portfolio is good. Today, we're going to talk about diving in more detail into that ex post analysis to think about how the different parts of your process are driving your portfolio's performance. So before we kick off here, what we're going to talk about today, this is a live ex post sort of real analysis of a client candidate portfolio. So what we're going to look at here is a long only global equity portfolio. This is all of our statistics, all of our data, all of our returns are going to be in benchmark relative space. It's a long only benchmark portfolio. What we look at with this PM is we look at their data on a monthly basis. So on a monthly basis, the PM selects stocks, assigns convictions. We've built with them the portfolio shape definition. So that's our selection process, that's our scoring process, that's our shaping process. And then finally, the PM has already taken sort of a heuristic approach to constructing the portfolio, to sizing the positions. But Sherpa helps them using the optimal risk sizing tech to do sizing and construction analysis to try to improve on that sizing piece. So what we're going to talk about today is going to be all in this portfolio, all in benchmark relative long only equity space. So Richard, what do we mean by selection? What can we take away from this?
Well, hey, Stephen, thanks very much. So the very first thing we want to look at is broadly, did you pick the right stocks, or did you pick stocks that on the whole, I mean stocks, this happens to be stocks, assets that on the whole, the things you were long went up and the things you were short went down. Again, a long only benchmark portfolio, so we're talking about, did your stocks outperform your benchmark on average? And so the first S of Stephen's four S's, right, selection, we can look at it through this ex post lens of candidate portfolios to get a metric of how good was your selections. Now, this is very different from just saying, oh, you returned, and this guy, I think he overall beats the benchmark by 70 basis points or something over the 6 months. So if you start, if all you look at is, oh, you made 70 basis points over the benchmark, you get one sort of number. But remember, the purpose of this webinar is to talk about trying to understand what really drove that number. So the first thing to look at is this overall picture of what your selections did. Now, separating the selections you made from the other three S's, from the scoring, the shape, the objectives and constraints of your portfolio, and your sizing, necessitates saying, okay, for a given set of assets, a set of selections, what could all the possible outcomes have been which were still compliant with your overall objectives and constraints? Your sector limits, your country limits, your whatever other things you have told people that your portfolio will do. So this picture here, the green lines, and remember, this is not a simulation of the market. This is the true market over the last 6 months applied to many different possible ways of building a portfolio from the selections that the client had, which were compliant with the client's objectives and constraints. Say that again. Hold on a second. So each line represents one possible portfolio that the client could have built given the stocks he chose. And I think, Stephen, there's like 50 stocks in this guy's portfolio, something like that. 70 stocks. So 70 stocks, but of course the benchmark MXWO has got like 1,500 stocks. So 70 out of the 1,500 he has chosen, okay, happens to be a he in this case. Each line represents what could have happened had he built his portfolio in one way or another. And from that, you get the overall impression like, oh, actually, yes, the selections were on average, they worked because the lines all outperformed the benchmark, or the benchmark is, everything's neutralized here to benchmarks. The benchmark is the purple line across the bottom. So in general, the PM's asset selections were good. Now let's get into this in a little bit more detail. You can think about what that picture looks like in lots of ways. I mean, the full information is in the picture, and the picture tells 1,000 words. This is normal. So the picture itself is actually a very good way of doing it. If you need to break it down into something simpler, of course, you can say, well, the average or the median portfolio, what did it do? And so you can see here the average and the median are broadly similar. That in itself is quite a strong statement. If the average and the median are, the average meaning just the mean, or the arithmetic mean, and the median are different, then it tells you you've got some sort of some sort of surprising behavior in the portfolio, and particularly in a portfolio of long delta 1 stocks, that would tell you that you've got something very strange going on. My first reaction, if that was the case, actually would be to check my data, because I really wouldn't expect it. If the data is fine, then I'd be saying, well, then there must be some real outlier performances somewhere. Something has driven this gap between the mean and the median. But so the very first thing that says to you is, okay, my mean or my median, 83 basis points up over the 6 months relative to benchmark. So he's annualizing.
1 month in this case.
1 month. Annualizing it at whatever it is, 150. I thought, okay, sorry.
Portfolio.
So right, okay. The next thing we can look at. Sorry. Move forward.
Sorry, message came in and it took my off screen.
Okay, so now the client assigns to each of the 70 stocks in the portfolio a conviction, and with this client we've broken the convictions down to high, medium, and low. So very simple, and he's got 20 or 30 stocks in high, 20 or 30 in medium, and 20 or 30 in low. So it's a reasonably well-balanced separation of convictions. The question then is, well, so we know his asset selection has had some quality, right? He's made 70 or 80 basis points return over the benchmark. So his asset selection has been good. But has his scoring, that's the second S of Stephen's 4 S's, has his scoring really added any value, or is there any real information in it? And so if we, I mean, again, it sounds quite trivial, but if you draw a picture, and this time we've got each line represents one asset, and we look at the return on that asset over the time period, and we say, well, if we separate, I mean, we just color the lines according to conviction, and you can see, you know, this case, we haven't benchmarked everything. Benchmark is the purple line. The high conviction lines are the dark blue. The medium are the sort of middle blue, whatever you call it, and the orange are the low conviction. And if there was clear differentiation in the average, in the sort of pattern of the lines, so the dark blues all outperform the medium blues, or kind of broadly outperform the medium blues, which broadly outperform the oranges, then you'd be able to say, not only is there value in his selection, but actually his scoring also has value. In this case, though, that's not happened, right? We can see that the lines were all sort of jumbled up. So yeah, thanks, Steve. We can see the lines are all jumbled up, and then if we just do the basic stats on the lines, which is the table, we can see, yeah, all three, the ones, twos, and threes, the medium, the low, medium, and highs, have outperformed the benchmark, but actually the ones have on average done better than the twos, which on average have done better than the threes. Right. So what we're saying here, and this is not actually that surprising, the PM has been very good at asset selection, but when you ask the PM to be more granular, to separate out what I really like from what I don't like, whatever, actually that kind of loses information. And in fact, if the PM had built a portfolio where he was more risk, more weight in his ones than his threes, he would have done better. So the act of asset selection has generated alpha, loosely defined, whatever that word alpha means. The act of asset scoring has actually removed alpha. And this is not something that unusual. We see this, well, we do see this quite often, and we see certainly that the more granular the alpha metric is, the less likely it is that actually it's adding value. And that's just something to keep in mind.
And this is something you see a lot when PMs have a very distinctive style. Their asset selection broadly might do well when that style is doing well, but their ability to differentiate between assets in that style is another meaningful potential source of alpha, but it's usually much more difficult.
Yeah, and I think it's a harder thing to ask, because you start having to justify things at a much smaller level than, look, this is a good stock, or it's a good company, or whatever. Anyway, so that's a thing we see quite a lot. One thing you can check again, and I mean, this is relatively common sense, but it's common sense, but I don't think it's done particularly thoroughly or well in many cases. Just to look and say, well, okay, where did you outperform the benchmark? And you can call it hit rate, or you can call it what did well, what did badly. On average, again, 50% of his stocks outperform the benchmark. You can see that the ones, the low conviction ones, more of those outperform the benchmark than the highs and the mediums.
This one's really just a check on that same visual about the outliers, because sometimes the averages can wash out when you have, a stock that, for whatever event-driven reason, increases 70% or loses 50% of its value in one period.
Well, certainly in this, I mean, over the last year, since the February, March sell-off last year, we've had some stocks that have done 250%, and it's quite easy to get the wrong impression from the simpler data. So the table's good, the picture tells 1,000 words. You kind of have to take the whole thing in one go. But anyway, so we've looked at the selection part, which was the broad picture, and we've looked at scoring part, which is how did your ones do relative to your threes or whatever. I mean, you don't have to use 1, 2, 3, 1 to 10 or whatever, but how much extra information or negative information was there in your scoring session? The other thing we can do is look at how the shape, and by shape we mean what have you said to people that your portfolio is. The other thing we can do is look at how does the shape impact your end result. And we went into this in quite a lot of detail in one of the previous webinars, so we probably won't get too much depth in this. But if we look at how wide the final distribution of possible returns is, so we know the selection generated some upward slope. We know that the scoring didn't really add anything to that. But how wide are what is the breadth of possible outcomes you can have? And of course, that is defined or broadly defined by what restrictions or objectives or constraints have you put on yourself as a PM. And that could be, in the case of these benchmark portfolios, it could be how much active share can I have in total, or at a sector level, or a country level, or at a single asset level. It could be about, I mean, some people, it has to be active share above a certain size, some has to be below a certain size. You can create shapes which are slightly difficult to accomplish, which has the impact of really reducing how many possible outcomes you could have and having a much broader spread between them. So to go, if you move one asset slightly, then it forces lots of other changes in the portfolio to maintain, sector parity or whatever shape you set. So the point of this candidate portfolio graph is it should show you something with a distribution of outcomes like the one you see here, where there's sort of a clearly defined middle and a few outliers, rather than the shape constraints forcing all the possible outcomes into one packet, which can happen.
And that spread needs to be consistent with what you expect.
Yes. Yeah. Your shape should not allow you to be, well, I mean, that's the purpose of the portfolio objectives and constraints, is to create the trading envelope in which your investors will experience life. I mean, that's what is the LP experience is always the question to ask. The shape of the portfolio, the objectives and constraints define for you what the LP experience is. So again, the picture tells 1,000 words, but here's a sort of the table of the words. We can look at what the worst possible portfolio, and this is all ex post, right? So we know this for sure. The portfolio that performed the worst, the portfolio that performed the best. What's their overall return? What's their volatility? What's their relative drawdowns? And in this particular case, you can see the interesting thing is, of course, the drawdowns within important numbers, they're broadly the same. But there's a clear reduction in volatility as you go from your worst portfolio to your best portfolio. So if you'd made the worst portfolio, not only would you have had a lower return, you'd have had a higher benchmark vol, a higher tracking error in benchmark speak. So you can sort of see that actually it's quite easy to convert what is a good set of asset selections into a very varied set of returns. You can get 30 bips with a vol of 4.5, tracking error of 4.5, or 130 bips with a tracking error of 3.5. And those are very different lived experiences for the LP. So we tend to look at either of these two metrics. The best to worst generally isn't so interesting because there's going to be one or two that are, wildly out there. But the 90-10 or 25-75 percentile spreads give you a pretty good guide for how wide your possible set of outcomes are. And that really is driven by what you have said your objectives and constraints, what your shape really is. So that's the third of the three S's. And then the fourth one is, okay, within all those constraints and selections, what actually did you do? So in this case, the PM's portfolio over these 6 months is the red line Stephen has put on here. And you can see it kind of looks like it's about halfway up the possible outcomes at the end, although in fact the bulk of the density is above it. So it's at the 28th percentile. And you ask yourself, well, all right, so my actual return stream was the 28th percentile of all possible return streams I could have had, given the selection I made and the scoring I added to them and the shape I put around it. And that's telling you that perhaps you underperformed what you could have done due to the fourth S, due to actually your sizing, right? The selection was pretty good. The scoring we saw wasn't so great. The constraints told you where you could have been, and your actual outcome was 28th percentile, which is not really very powerful as a number. Typically, and again, I mean, this is a heuristic, but it's normal that we see that a portfolio constructed without use of the kind of tools that Sherpa has gets to somewhere between the 45th and 55th percentile is the sort of thing normally we see. So the 28th percentile, from the 28th to the 50th, there was a spread of what, about, was it 13 basis points? That's right, yeah. So with your selection and your scoring and your shape, your sizing ended up costing you about 13 basis points on this portfolio to the kind of average, to what you should have been able to do without any clever stuff, right? If you have the clever stuff, ORS, and we've talked in many details in many webinars about how this works and why, but if you have the ORS, your percentile typically, in this case, actually, we did pretty well, didn't we? Like 90.
This was a good period.
That was a good one. But I would be more like confident to say that in general, we'll get you from around about the 50th to 65th to 75th percentile type thing, which is still, 20 or 30 basis points higher than this particular manager did. And in the context of that very tight possible spread, which is like 1%, that 30 basis points is a very large uptick with no greater risk, right? Increasing the return with less or the same amount of risk is what the clever bits do. Assessing what you've actually done using this candidate portfolio framework and looking at your 4 S's allows you to say, where am I doing well? Where can I do better? And so, yeah, this is the final picture, right? The green line's what every possible portfolio could have constructed. The red line, the one you did construct. The blue line, what the Sherpa cleverer way of constructing portfolios using all the same inputs would give you. And in this case, our blue line is very good. No apologies for that, but I would say in general, I would expect it to be around about 65th to 75th. We just happened to hit 95 this time, which is great.
Well, that segues into the other topic we want to talk about here is that if we're taking all of these metrics, all of these things that we've talked about, this gives a fairly clear scorecard. And you could go into a great degree more detail on every one of these. I mean, you could slice and dice selection 100 different ways. You could go into scoring at greater granularity. You could, really talk about the distribution of the assets within each score. Same thing with shape. You can talk more about the different risk metrics, or if maybe you have a different risk metric. Maybe you care about a CVAR or something else. And then with sizing, you could go through and compare multiple different potential compositions. Maybe you have 3 different technologies that you use to do, or maybe you're doing it where you have a sample where you were thinking about doing it a different way, and you knew that you could have done it this way, and this was one of those many candidates. So this scorecard summarizes, if we think about how did those different elements combine. So like we said, in this period, the selections were good. The scores didn't really help. The shape was tight, which is what the PM was looking for because he's very tight to benchmark. He's running a long only benchmark portfolio, so he didn't want a big spread. And his actual implemented sizing left room to improve. And what Richard's talking about, where sort of our experience is that many PMs are in that 45th to 55th, broadly speaking, around average. And that if they're using better tooling and better process, they can be more consistently good, and good being sort of 65th to the 75th, say. This is where you have to track this information over time. If you look at it in one period, it helps explain what happened in that period. If you look at it over time, it starts to paint a picture of tendencies. It starts to paint a picture of what you're doing right or wrong consistently. So there are going to be bad months. I mean, this PM is a PM with a lot of experience. Every PM has bad months in terms of sizing. Every PM has good or bad months in terms of selection. And so to really think about this in a process-driven manner, to really take sort of an engineering style approach to thinking about which parts of your process are working, we need to take these different metrics, take this scorecard, and track it over time to see which parts of the process are strong over time. And so if we look at selection quality, for instance, we can see over 6 periods here, 6 monthly periods, where the PM in any given month, the selection quality varied pretty significantly. There were periods where his selections were 80 bips above benchmark. There were periods where they were 70 or 80 bips below benchmark. And so if we look at this on average over the course of those 6 periods, we can see that his picks on average, using that scorecard that we've just tracked through, on average, his picks had some information. On average, his picks beat the benchmark. We're not talking about a huge margin, but again, this is a game of inches. This doesn't tend to be a game of home runs. And so on average, if we track this, we can say his selection wasn't great, but his selection was pretty good. If we look at his scoring, and again, we take the same information, we take that same scorecard that we previously used, and we track that again over time, we can say, on average, how good was the scoring? On average, was the scoring help? Is it something that he should lean into? Or is it something that he should maybe be reducing the influence of in terms of how he actually implements the portfolio? And so if we look at this, in about half of the periods, his threes, his high conviction ideas were very good. So those were the navy blue lines in our earlier chart. But really, it wasn't a slam dunk again. So maybe from a portfolio construction decision, does he want to maybe emphasize almost a barbell of high conviction ideas in his threes and risk management focused low conviction ideas? Because it looks like on this sheet, this is saying over time, his twos are broadly speaking not been very good. His threes have been okay. And his ones actually have been very strong. If we take the same thing and we back this out in terms of shape, again, shape is a question of, as a PM, are you within the right envelope for the product that you've told your investors you're going to deliver? Is it an envelope that you as a PM are comfortable with, and is it an envelope that your investors are comfortable with? And so if we look at this, this is one where if your portfolio definition, if your shape is right, again, we've talked about this in other sessions, these should be relatively consistent numbers. Your spreads should be relatively consistent. Again, we said, remember that the midpoint of this distribution is going to be defined more by your selections, more by how good your ideas were during that period. But the spread should be broadly consistent. We can see the 90th to 10th or 75th to 25th spread here is, fairly tight and fairly consistent. There's not a great deal of variation, which in fact means that in terms of setting up the problem, the work that the PM's done with Sherpa to make sure that the definition is right has been actually very good, because that definition has been consistent and it's allowed him during different periods and different regimes where his ideas have been good or bad to remain in a similarly tight trading band. And so finally, if we take that together, again, we said that your selections and then your scores, then your shape in which you implement those selections and scores, and then ultimately the sizing and the construction of how you put all of that together subject to that shape. Again, if we track that through time, we can see that, in this case, the PM's original constructions were slightly lagging the median. And so again, that's, as we think about this in a percentile perspective, as we said, usually we would expect the PM to be plus or minus around that median, around that average. And so in this case, the green are the median portfolios. The orange again is the PM's original portfolios. And we can see that on average, this PM had slightly lower tracking error, but really within a rounding error, and slightly lower returns, but again, it's sort of within that, within that band that we've just described of being just sort of roughly around the median. And if he was using, and as we've helped him improve sort of the composition and the structuring, the ORS construction here was able to improve on those returns. So move him from slightly below average to consistently somewhat above average, which again, over time adds up. It's a compounding of moving from around the median, around that 50th percentile, 45th to 55th, to moving to consistently good, which let's call it is in the 65th to 75th percentile. And by doing this, we can capture more of the upside in the PM's ideas while mitigating risk and deliver more consistent results in the sizing decision relative to their selection scores and shape definition. So we've gone a little bit over time. Certainly, if anybody has questions, by all means, let us know. But broadly speaking, the take home here is that you have to measure all of these decisions. You have to measure the output of your process for selecting assets, the output of your process for scoring assets, the shaping, as you come together with the different members of your team or as a PM, as you make different decisions around min-max or sector weights or particular risk thresholds, your shaping decisions, and then ultimately your sizing. If you're tracking all of these things, it doesn't have to be the most complicated statistical measures in the world, but something that you can track over time. You can see how they evolve. You can see what you're good at, and you can manage the process towards improvement and towards informed improvement so that you're not flying blind as to what your actual drivers of performance are over time. Again, we talked about this before. Most PMs are focused almost exclusively on selection, and they tend to get bogged down in how did that stock do, and which stock was the great contributor, which stock was the real laggard, as opposed to thinking about this in a more statistical, process-driven manner. So again, thanks everyone for joining us. If you want to learn more about this approach, the process-driven approach to building a better portfolio, to getting more consistent alpha out of your ideas, get in touch with Richard and I, our colleague Craig here at the Sherpa team. All of us would be glad to help you anytime. This is what we do with PMs. We help them move and improve the decision-making within the portfolio construction process to make more informed decisions. Richard, any last comments before we let people go?
No, very good. Thanks very much, Stephen. I think that's really important. Really important the way you've shown how you can assess how well you're doing, because unless you measure this, you can't improve it.
Absolutely. Yes, if it's not being measured, you can't manage to, can't improve it. So thanks everyone for taking the time today. Again, if you were late to the session, this will be online on our YouTube channel. We also feel free to reach out for the slide deck. We also will try to get a written version up on the Sherpa webpage. So thanks everyone, and we'll look forward to joining you next time.
Thank you. Bye-bye.